Imagine waking up tomorrow and discovering that every country on Earth is in debt. The United States, trillions in debt. China, massive debt. Japan, even more. Europe, deeply indebted. But here's the strange part nobody talks about. If everyone is in debt, who is the creditor? Who exactly is the world paying? And an even deeper question, how can a system survive if the total debt is mathematically impossible to repay? This isn't just a financial puzzle, it's the foundation of the modern global economy. And once you see how the system actually works, you'll realize something disturbing. The global financial system may not be designed to eliminate debt, it may be designed to create it forever. For most of human history, money was simple: gold, silver, physical coins. If a king wanted more money, he needed more metal, and that created a natural limit. Empires couldn't endlessly create wealth out of thin air. But that changed in 1694, when something revolutionary appeared. The Bank of England. It wasn't just a bank. It introduced a radical idea: governments could borrow money created by private banking institutions. Instead of minting coins directly, governments issued debt, and banks created money in exchange. At first, this seemed harmless. But this small shift planted the seed for something far bigger. The real turning point came with a practice called fractional reserve banking. Here's the basic idea. If a bank holds $100 in deposits, it doesn't keep all of it in the vault. Instead, it keeps a small fraction and lends out the rest. That loan then gets deposited somewhere else, and that bank lends most of it again. Suddenly, that original $100 turns into $500, $1,000, or more circulating in the economy. Money was no longer tied to physical resources. It became expandable, and banks became the engines expanding it. This system fueled massive economic growth, but it also created a hidden side effect. Because every dollar created this way was not just money, it was debt. By the early 20th century, the system expanded even further. Central banks began coordinating national money supplies. In the United States, the Federal Reserve was created in 1913. Its purpose was to stabilize financial markets. But it also formalized the relationship between governments and banks. From that moment forward, government spending increasingly depended on borrowing money into existence. Wars accelerated this process: World War I, World War II, Cold War spending. Each crisis pushed governments deeper into debt. And each time, the solution was the same: create more money through borrowing. Debt wasn't just a tool anymore, it became the foundation of economic growth. For decades, there was still one restraint: currencies were loosely tied to gold. Under the Bretton Woods system, the US dollar was backed by gold. But in 1971, President Richard Nixon made a historic decision. The United States stopped converting dollars into gold. The dollar became a pure fiat currency. Money was now backed by nothing but government authority. This was the moment when the modern monetary system truly began. From that point forward, money could be created without physical limits. And the result was predictable: debt exploded. Today, the numbers are staggering. Global debt has surpassed $300 trillion. That includes government debt, corporate debt, and household debt. But here's the uncomfortable reality: if all the money in circulation was used to repay debt, there still wouldn't be enough, because interest must also be paid. And that interest money does not yet exist. The only way the system continues functioning is by creating new debt to pay old debt, which means the system must grow forever or collapse. Every few decades, the system breaks. 1929, the Great Depression. 2008, the global financial crisis. Each time, the response is similar: lower interest rates, inject more liquidity, create more money. In 2008, central banks introduced quantitative easing, creating trillions of dollars digitally. Then, during the 2020 pandemic, even more money was created at historic speed. Instead of reducing debt, the system expanded it, because shrinking debt risks triggering economic collapse. Today, we see the same pattern repeating everywhere. Housing bubbles, stock market booms fueled by cheap money, governments running permanent deficits, central banks trapped between two dangers. If they stop creating money, economies stall. If they keep creating money, inflation rises. This isn't a temporary problem, it's built into the structure, because the modern economy depends on credit expansion to function. Remove that expansion, and the machine stops. So, we return to the original mystery. If every country is in debt, who is the creditor? The answer is complicated. Governments owe money to bondholders, banks, investment funds, central banks, and sometimes even their own citizens. But the deeper answer is more surprising. The system itself is the creditor. Because debt isn't just an obligation, it's the mechanism that creates money in the first place. Without debt, much of the world's money supply would disappear. 1. Modern money is largely created through debt. When banks issue loans, new money enters the economy. 2. Economic growth now depends heavily on expanding credit. Without new borrowing, many economies slow dramatically. 3. The system is designed to keep expanding. Debt isn't just a problem inside the system. It's one of the mechanisms that keeps it running. For centuries, money was something tangible: gold, silver, coins you could hold. Today, money is something very different. It's a network of promises, promises backed by trust, trust backed by institutions, and institutions backed by the belief that the system will continue working. But history shows something important. Every monetary system eventually reaches a turning point. The real question isn't if the system changes, it's when. If this video made you rethink how money actually works, subscribe to the channel, because the stories behind the financial system are often far stranger than they first appear. And the deeper you look, the more surprising the answers become.